Something strange is happening in the lending world. Last year, 1 in 20 mortgages were non-QM, and that's just the beginning. By next year, non-QM mortgages are going to dominate the marketplace. If you're not familiar with the non-QM lending space, you're missing out on the future of lending as we know it. And wave goodbye as you watch your dream home become someone else's real estate investment. I'm Andrew Russell, owner and founder of RCG Mortgage, and I've worked with thousands of clients, business owners, entrepreneurs, investors getting non-QM mortgages even before they became the bee's knees. Non-QM mortgages, what the heck does non-QM even mean? So let's, take a moment and go back to around the pandemic. Unfortunately, around that time, the mortgage business was kind of booming. Why? Depending on the interest rates, are, at the time were going down so low, so everyone was refinancing, right? And out comes this cool new product called non-QM. So if you think about QM, there's a lot of regulatory stuff in America around mortgage. QM is qualified mortgage. Just think the normal vanilla conventional mortgage, FHA, VA, some of these mortgages are the very basic vanilla typical mortgage that we in America are very used to. Now, of course, here comes non-QM. And what does that mean? Take, for instance, I've worked with oodles and oodles of clients even before this became so popular, these non-QM mortgages. Number one, let's, for instance, an investor. Investors referred to me when these non-QM mortgage products came out, specifically DSCR, which we'll talk about in a little bit, debt service coverage ratio. You have an investor who wants to buy a multifamily property, and typically, if they weren't doing private money or a hard money route, which is, basically, a private loan for a year with super high interest rate and super high closing costs, if they wanted the vanilla, the QM-ish route, it would entail checking all their income, looking at all their tax returns, seeing how their accountant writes off all the information on their schedule of real estate owned. And oftentimes, even though there might be a seasoned investor, they didn't actually qualify. So a DSCR comes out, this new non-QM loan off market rent. Amazing. That was an example of a client that we work with all the time. Or a business owner. A business owner wants to buy a second home on the water in Florida, say in Miami. What do? We look at the tax returns with a fine-tooth comb. Typically, not us, of course, but mortgage companies put this client through the ringer with paperwork and CPA letters and, dissertation papers. Now came this new bank statement program. So instead of looking at all the tax returns and putting these people through the ringer and profit and losses and who knows, audited, non-audited, qualified statements, gets a little bit spicy when it comes to self-employed, typically with vanilla loans. Now, all of a sudden, there's just bank statement programs. We had a client, same thing, referred to us, and they wanted to buy this amazing property right on the water, several $1 million. They were putting about 30% down. And instead of doing the multiple year tax return route, all of a sudden, we said, listen, there's this new product that came out. You can give us 12 months of your business bank statement. We're going to look at the deposits, not your tax return. So even if you show a loss or even if the bank statements don't have all that much money left over month over month, you would qualify. And it shocked the market, a few years back. And that was an example of a client that desperately needed that type of loan product because they put all the money down. They had a great credit profile, tons of money left over in the bank, but just the way the banks were looking at income, it wasn't going to work for them. Or, another option with these non-QMs was, as an example, real estate agents or 1099 contractors. Typically, they're Schedule C sole proprietors, where they take that 1099, call it for $250,000 for the year, and in their head, they make $250,000. But of course, to the IRS, and then of course, especially to the lenders, they are only as good as the profit that they show. So that $250,000 gets written down to $50,000 after expenses. And now that's all they're getting credit for to buy a home, where we say, hey, listen, this, again, new product, 1099 contractor under the non-QM umbrella. We just need your last 2 years 1099s, and we can go off 90% of the face value. What's the catch? There is no catch. But of course, I hear all you guys all the time saying, hey, Andrew, I don't get it. This non-QM stuff, it seems so easy, right? Like there has to be a catch. It takes forever to close, impossible process, and you pull your hair out. Well, I didn't pull my hair out. This is genetics, folks. Thanks a lot, Poppy. But regardless, it's so much easier because think about it. The fastest way from point A to point B, from application to close, is probably as little paperwork as possible. And these programs require so much less paperwork if you're self-employed, if you're 1099, if you're an investor. So it's actually easier and faster to close these. Myth number one, debunked. Number two, hey, Andrew, the rates on these are probably so much higher. Has to be, right? There's always a catch. The market rate right now is 6.5. These programs are 8, 9, 10%, 12%, right? Sometimes they correlate to the auto finance world with APRs to the mortgage world. No, it's not the case. Besides some states having regulation about high cost loans and you can't have a rate higher than the average market rate, it's specifically New York as an example. These programs, if the market rate is 6.5, you're talking a quarter, 0.5%, if that, even in terms of a higher rate. So again, myth number 2 debunked. No, the rates are not all that much higher, if at all. Number 3, Andrew, what's the catch? They're predatory. There's adjustables. People are losing their houses. It's not the case. These, in my career of the last several years, I would say 99.999%, and that might be an understatement, have taken 30-year fixed rate vanilla mortgages, with no exotic terms, no balloons, no prepayment penalties on primary and second home residence, believe it or not. So they've been very, very safe. 30-year fixed rate mortgage is considered the safest loan, very vanilla. And because of these products, there's so much more product available for those different types of clientele. So, non-QM mortgages, what are they? Clearly you see this guy is super hyped about non-QM, but it sounds like another language. A lot of acronyms, kind of sounds confusing. So let's talk about non-QM, what it means, some of the products within the product suite, and why they're so valuable to the mortgage community and why I'm so hyped about them. So if you think about it, let's just talk about the normal vanilla-ish mortgage that most of this world is used to, and then what non-QM kind of brought to the space, and show you each of them, some of the pros, some of the cons potentially, and why it might make sense to do non-QM. Maybe it makes sense not to. Let's take a peek. So if you break it down into 2 sides, you have obviously over here, we're going to call this pre-non-QM, and this will be our non-QM side. It's like BC and AD, right? For all you educational geeks like me out there. So, again, we have our conventional mortgages, we have our FHA. Conventional is typically Fannie or Freddie. FHA, VA, USDA. We have portfolio. What does that mean? You walk into a big bank, they keep it on their books, maybe a credit union. You have HELOCs, maybe something called a HE loan, home equity loan, could be a second mortgage. You have a lot of, typical normal mortgage products that exist. You have potentially a reverse mortgage. Some of us mortgage cats call those HECMs, home equity conversion mortgages. So this is kind of before the non-QM world kind of, popped off a few years back. This is what we try to put all clients in and give them, of course, the best rate opportunity depending on the lender. But this is really the landscape of the mortgage market. Now, of course, here comes non-QM. And what came out first? Typically we saw for the investment side, DSCR, which is really, you have to be living on the rock if you haven't heard that 4-letter acronym. Outside of that, of course, came our bank statement program. So these two were really the most probably popular, or the first 2 that kind of popped off. So, there was a period, I remember, where the 30-year fixed rate mortgage, we'll call this vanilla, say like 3.5. And I remember DSCR was only 4.5 to 5.5%. So the difference of interest rate even now versus DSCR is very similar to what it had been back then. But just to prove a point, I remember for a good buddy of mine, we did a DSCR where I think he got like 4.75% on a 30-year fixed, even with an interest-only option. So rates were really good on these. And then I guess, whatever happened with COVID, there was concerns that this type of clientele wasn't going to pay their mortgage. So these like literally came off the shelf pretty much overnight. The bank statement programs became popular. It was first originally 24, then went down to 12 months. So it was really 24 months. You'd have to supply, if you're self-employed, 24 months of your business bank statements. And we were going to look at the revenue. And then from there was a couple different calculations on how we looked at actually what you made, which we'll talk about in a little bit. That eventually turned into 12 months. So some of these programs, they started with, maybe 30, 35, 40% as down payments. From there, they actually lowered. And of course, as clients are paying the mortgage on time, which is obviously what the mortgage market cares about, right? Is the security paying for itself? Because it's ultimately a mortgage-backed security in one way or another. We're like, okay, we'll loosen it up a little bit. Maybe initially these were 740 credit scores. Now it went down to 720, 700, 680. That's just how it always seems to work, especially if these are performing well, if the clients are paying their mortgage on time. Or 30, 35, 40% as a down payment. We'll teeter with 25%, see what happens. Oh, clients are still paying their mortgage on time. Let's loosen it up a bit, folks. Let's try a 20% down payment. Now, I've seen as little as 10% down on a bank statement program, believe it or not. Do I think 5% is coming? Not sure. The whole thing is if you put, so you have 20%. If you're 20% or more, there's no mortgage insurance. If you put less than 20% down, there has to be some form of private mortgage insurance, or the lender is self-insuring, meaning if you're putting less than 20% down, you're considered more of a risk, so the rate is a lot higher. So say the going rate is 7% for a bank statement program. If you put 15% down, could go up to 7.5 to 8. 10% down, we've seen into the 8+, at least at this point of the market. 5% may not be worth it. Plus, you're going to fail all these local high-cost tests that I told you, where the rate offering you're getting is so much higher than the national average. The state just will not allow you to close, believe it or not. So these were the two first popular loans that came out on the non-QM side. So the differences are, on the investment side, you normally would have to go Fannie or Freddie, or you would have to go portfolio, meaning portfolio loan, the specific lender, call it a credit union, or call it, some of the bigger banks, Wells, Chase, Citizens, Citibank, outstanding companies, they would make their own rules. And if you catered to their rules, you would qualify. So Fannie and Freddie had their own rules for investments. The amount of properties you could own was a caveat. Sometimes they didn't want more than 10. Sometimes they didn't want more than 4. Credit score minimums, if you owned a certain amount, it had to be a 720 or above. They look at your tax returns to see how you write off your expenses for these investment properties, which if you have a CPA that writes off specific expenses, not realizing could affect you to buy future investment properties, you just won't qualify. So this is really what existed for the investor pre-COVID. Then came these DSCR, debt service coverage ratio loans. Now, there had been some options available on the commercial side, or depending what lender you worked with, but these became more mass offered, and it was based on purely the market rent. So market rent, it's just as simple, a DSCR loan. If we put it down here, so market rent is basically if your mortgage payment is $1 million for a family, 20% down, $800,000 loan, $5,600 mortgage payment, plus tax and insurance. Say you're at $7,500 a month, all in for a 4-unit property. As long as, initially at least, if you put down, and these started as well, 25% down, 30%, a little bit more, good credit. When they first test the market with a new product, you're always going to be conservative. But as long as the market rent was a 1-to-1 ratio or greater, meaning if you took, we said a 4-unit, as long as, say each unit is $2,000 in rent. So you have 2, 2, 2, and 2. These are each of the 4 units. As long as you add that together, it's 8,000. 8,000 is higher than 7,500, which means it's at a greater than 1-to-1 ratio, meaning the market rent of what the appraiser says the units can rent for has to be at or greater than the mortgage payment, and you qualify. That was the most simple, keep it simple strategy way to explain what a DSCR loan was. Typically, these were 30-year fixed-rate loans. They didn't have prepayment penalties initially, so it was just a very clean loan, a little bit more money down initially, a little bit better credit score. But that was something that came out, and it's like, wow, you can work with an investor and not give them some really horrible private money, rehabby loan type with high interest rate and high closing costs. You can give them a vanilla 30-year fixed rate mortgage and give them a great competitive interest rate as long as the market rent covered and there's no other income documents or any other type of check. They wanted them to be a repeat investor. It couldn't be a first-time buyer or a first-time investor. So there's a lot of caveats when it first rolled out years ago. And it's definitely morphed into more and more into something that's super easy to qualify for, a lot more affordable. But that was the first iteration of the DSCR loan as well. So some of the pros of this rolling out were it was far easier to qualify just on market rent. No income docs, nothing too crazy in terms of documentation you had to furnish. They want a little bit more money left over in the bank initially, a little bit higher of a credit score, but the pro was it was so much easier to qualify. The rate was still great, and there was really no cap necessarily in the amount of loans you can get. Cons, I'm not going to say a con, but this has kind of turned into, for the better pricing for a DSCR loan, there's something called now a prepayment penalty. A prepayment penalty it's nothing horrible, but if you pay it off within the time frame of the 1, 2, 3, 4, or 5-year prepayment penalty, you actually have to pay a little bit higher of a fee on the payoff statement, or if you sell the property as an example. It's not a bad thing, but what it means is that the servicer wants to see you kind of locked into this mortgage, because typically the first 5 years on a 30-year fixed rate mortgage is interest. So they want to make sure they make their interest on you. The average mortgage pays off or sells in the first 5 to 7 years. So they really focus on the first 5 years, making your interest. So prepayment and penalty for the better pricing, it could be considered as a con. But ultimately, this loan specifically has certainly taken market share and it's very popular. But that obviously, same concept for the bank statement program. What are some of the pros from some of the cons? So if you were self-employed, Fannie and Freddie, maybe you'd get away with a 1-year review of your self-employed income. But again, if you think of self-employed income, a lot of our videos, which you guys should check out otherwise, have gone into how they actually calculate said self-employed income. Actually, do me a favor, guys. Right now, go in the description, click the link. There's a QM versus non-QM cheat sheet that my team has spent so much time making. It's free. Make sure you go in the description, click the link, and get that right now, because all this stuff to me, it's all in the brain and it's all easy to explain to you guys, but an easy cheat sheet is always the best. Make sure you go in the description, click the link, and get the non-QM versus QM cheat sheet. It's going to be the best way from a roadmap perspective to show you the differences and which one will work for you. So again, if you're self-employed, sometimes if you consider revenue, expenses, profit, that's a very revenue minus expenses equals profit. It's the easiest way to explain a self-employed tax return. So unfortunately, the banks go off profit. Where to many self-employed clients, entrepreneurs, business owners, they say, well, my company revs $10 million a year. And in their head, they make that amount of money, even though those are expenses. Because when you're W-2, if you made $10 million a year, you don't kind of take into account your life expenses. You just think, I make $10 million a year. Same thing sometimes with business owners. But no, we go off of this profit amount. And that becomes problematic oftentimes for the self-employed community, to a point where most self-employed clients think it's really hard to actually buy a home and you have to position yourself to be able to afford it, which takes a lot of time. Or FHA and VA, some of the government loans, maybe even portfolio, they look at a 2-year average instead of 1, which is even more problematic, because what if the income is declining? What if year over year goes down 20% or more? What happens? There's a lot that kind of goes into it. So it's typically a pain in the butt, if you're self-employed, to get a mortgage in the pre-non-QM days. Now here came this bank statement program. So this same self-employed client, we'd ask for 12 months of the bank statements. So each month we'll see what is the incoming revenue. We don't care about what's going out. We don't care, as long as it's not in the negative after, of course, but we don't care about how much you save each month per se in that account. We will look at the incoming revenue, and whatever that incoming revenue number is, we'll compare it to every month, month over month, and look for trends. We don't want to see it going down a lot and up. Like, we want some kind of stability within reason, depending on the type of business. And we will give them credit for, if they own the company at 100%, half of that, 50%, for income. So this is the first iteration of the bank statement program. It's like, hey, do you have any self-employed clients, which over here we do, and it's super difficult for them to qualify oftentimes. Hey, do you have any of these self-employed clients, business owners, etc.? Instead of asking for their tax returns, let's get their last 12 months, or at the time when I first rolled out, 24. They wanted a 2-year history, which is very typical. Now 12 months is acceptable. Let's look at their bank statements, the incoming revenue, because that's what they make, right? The revenue per se. And instead of doing this type of guideline and income review, let's see how much they own of that business. Let's say 100%. And then from there, if they're a 100% owner, you can't give them credit for all the revenue. They'll give them credit out of the gate for half. So this revenue number, remember we said there was somebody making $10 million a year in revenue in their head, but maybe like the net profit, they only show $250. You say only show, like that's not that much. But say they write off a lot of their expenses. So that's about $800,000 a month of revenue. But again, they write off all their expenses, all the allowed expenses per the IRS, and they show $20,000 a month of income to themselves. This program, right, if you follow the math, which was so cool, oh my God, reach out to that self-employed client now, and that $800,000 of monthly revenue, if they're a 100% owner, you can give them a credit for half of that, believe it or not, for income. So think about that. You just 20x'd their qualification and income just by this program. So as you could tell, this program became quite popular. But initially, just like the DSCR loan, it was a little bit more conservative to roll out. The down payment was 25-30% at least. If they're first-time buyers, a couple more overlays or requirements just to make sure that it's something they could afford. Rent history was super important. They wanted to make sure that they actually paid rent if you lived rent-free, maybe with parents, at the time. Was actually a no-no. So there was a little bit more conservative, to these type of programs. But again, as we said, say we start with 30% down the market and a 740 score requirement. What happened? Well, these clients were paying their mortgage on time. So that loosens up to 25% down, then 20, and like we said, down to 10%. So the bank statement program, again, this came off the shelf after COVID, similar to the DSCR, but came back. And then it was a wide gap between the market rate and the interest rate offering for the bank statement program. And it's definitely, kind of came closer where it's almost the same, because this market, this type of client is paying their mortgage on time. That's what we're seeing. They have more equity, so more to lose, more money left over in the bank, so they require a certain amount of reserves or mortgage payments left in the bank. So these two programs were really the first two to come out hot and heavy in the non-QM, pre-non-QM days, let's call it. Outside of that, there's been a lot more iterations of programs. So for instance, if we just make a cool little section over here in green, what else have we seen? We've also seen some 1099 programs. So as we said, on the 1099 side, these didn't come out as hot and heavy initially, but if you're a 1099 contractor, like normally we would look off of a Schedule C. Now we just look off the 1099s, which is super cool, right? Wouldn't it be great if, to the case of a real estate agent, they made $250,000 for the year in their heads, but to the IRS they showed, as we talked about in the previous example, $50,000 as a profit. Now we could just go off that 1099. What's the catch? Yes, the rate's higher. How much? Not all that much. A quarter in rate, if that's going to prevent you from buying, it's probably not the right property for you. That's probably going to be another $100 a month, or an extra couple $1,000s in closing costs if you buy the rate down to keep the payment the same. So that was a program that came out that's very popular as of late, as the non-QM suite has kind of expanded. There's asset-based programs now, which is cool. So there's a program where if you're getting a $1 million loan, right? Let's use a $1 million loan example. Not like everybody has $1 million from a loan perspective for need, but just always a clean, easy number. $1 million loan, if you have $1 million, $1.25 million, $1.5 million in the bank, after we close, it's called an asset-based program or asset-based lending, where you actually qualify. It's just that simple. As long as you have a certain amount of money left in the bank after, they don't ask any other questions. Or if you have certain monies, they divide it by, say, 60 as a number. So if you have 1.2 million, you divide it by 60, that number will be a monthly income number that they give you credit for. So this asset-based lending stuff, there's a couple different examples as we went over, but that didn't exist in the pre-non-QM days. This is something that came out. So if you're very strong on the asset side, for a very similar interest rate, there's now opportunities for them as well. Outside of this, on the investment side, this started typically on a 1 to 4 family, a 1 to 4 unit property, and maybe a condo. Now, on the DSCR side, these are becoming very, very popular for 5+ units. 5 to 8, maybe 9+. We've seen it with an 11 unit property. So all these programs have really expanded. So for whatever reason, the market seems to love these, both clients and the investors alike. And as long as the clients keep paying, which is what matters, and the security, right? All the mortgages you see in the movies, right? Bundled together into one big security. As long as that security performs, meaning all the clients in these mortgages are paying them on time, they will continue to expand. So in another year, when I do another video about what I just said and call it like the pre-new non-QM days, it's a little bit of illusion there. There might be in this bucket even more loans just because the performance is so good. More is definitely on the horizon. This is why all the articles, guys, there's an estimation of their 30% of non-agency mortgages will be non-QM. Sounds confusing. What the heck does that even mean? It just means if you consider anything non-vanilla, non-conventional, government, which is Ginnie Mae, some of the MBS stuff for conventional Fannie and Freddie, all the other stuff called non-agency, it's the non-QM share is growing within it. It just means that these loans are here to stay, and you should definitely, if you don't research them, again, go in the description, at least at a minimum, click the link and get our free QM versus non-QM guide. This is something that if any of this interests you, if you're going to be a home purchaser, or if you're going to refinance, or you just want to educate yourself on the mortgage market in America right now, this is something that is certainly going to be here to stay.